Are rate hikes from the ECB, from the Bank of England, is that currency positive or currency negative in this market regime?
You know, this is what the market's trying to get to grips with. And this is really highlighted this week, particularly for the Bank of England and the data, because at the start of the week, we had a really tight labour market data. And, that raised the question of, well, is the labour market here more resilient to interest rate hikes? Bear in mind, we've already had 4 consecutive hikes from the Bank of England, and yet the labour market is still tightening. And so that led some commentators to the view, well, look, the Bank of England is going to have to do more then in order to create that loosening in the economy to try and bring demand down. And yet now we have consumer confidence data this morning at its lowest levels, its weakest levels since around about 1974. And of course that highlights the cost of living issues that we have, the cost of living crisis in the UK. And that again, and we've talked about this before, it's difficult perhaps to reconcile this really tight labour market, too much demand on one hand, with the fact that there is this cost of living crisis, and many people are really feeling the pain of higher energy and food prices. So what does the bank do? And that's what we've got to try and conclude over the next few months.
Jane, you have been world-class on avoiding FX hysteria. There's a modest hysteria over a repeat Plaza Accord, and those levels are out, depending on who you talk to, way out. Euro 90, week euro. Yen 135, 140, 150, week yen. Do you have any framework where those two currencies would weaken and the dollar would mega strengthen?
Well, the first thing I would say, I'd come back to Lisa's comments at the start of the program. The Fed is tightening interest rates, and that means equities are likely to go down as they have been, and the dollar is likely to go up. And that's the reality of a central bank tightening liquidity into the crisis. So I find it very difficult to understand, calls like, the Fed or the central banks have got to get together and soften the dollar to help emerging markets, etc. It doesn't make sense to me. We're going to have a stronger dollar in an environment where the Fed is tightening interest rates, and when there's generally this risk of appeal, and that's related to, first of all, maybe fears about the US economy next year, but also the possibility that Europe could be in recession if there is an oil embargo on Russia in Europe, and also this slowing China story. And that's really significant as part of this risk-off environment. So I think the dollar is strong. Now, can the yen pick up? Well, we've seen some safe haven going back into the yen over the last week, similar with the Swiss franc. That, I think, was on the back of better than expected current account data for Japan last week. So for 2 months in a row, we've had 2 current account surpluses. It had appeared for a while that with energy prices, with commodity prices so strong, that would erode the ability of Japan to hold a current account surplus and therefore dampen the yen's safe haven appeal. But that's coming back to some extent. But I still think the dollar is going to be king in this sort of environment.
Well, but how much more can it continue to be even bigger king? In other words, how much of these gains basically been baked in at a time when the narrative that you basically just put out is basically the widely accepted one, and you're starting to get more pushback from the likes of George Saravellos reconfirming this morning his bullish call on the euro versus the dollar, because this is all baked in, and now the only surprises could really come to the positive side from Europe.
I'm not so sure that is the case. And to be honest, I think we could be having this conversation since December. In fact, I have been having this conversation to December. All of the news is baked into the price of dollar. And at every turn, we've either got a more hawkish Fed and then more recently, more negative news about the global economy. And that's why I think China is a large part of the answers to this. So, for instance, we had more cases overnight in Beijing of community spread of COVID. And that dashes the trend of the last 4 days that there were no community spreads, and that of course had been raising expectations about a loosening of restrictions. If we get more community spread, then that is going to dampen expectations about Chinese growth even more. And actually our view for Europe is that there will be a recession at the end of this year or early next year, and that's because our house view now is that there will be an embargo on energy, and that means a recession for Europe is unavoidable. So I don't think that everything is yet baked into the price. I think China holds a lot of the problems. If growth there worsens, I think the dollar will firm on safe haven appeal, and also for Europe, I think that there are more risks for growth in that direction too.
Jane, I've got to squeeze this in. Recession year end in Europe, is that with rate hikes or without rate hikes? And if it's baked in, do they really want to be hiking into that?
Well, I think the reality is that the window of opportunity for interest rate hikes from the ECB is probably going to be very, very narrow. More and more people from the ECB have been talking about a July move. I think that's coming. To a certain extent, I think there's some jawbone in there to try and prop up the value of the euro, because obviously a weaker euro is going to make the inflationary issues worse. So a little bit of jawboning, a little bit of interest rate hiking, but I think by the end of the year, I think the growth conditions could be too poor for them, assuming, of course, that there is this embargo. And that, of course, remains up there. We haven't had a decision on that yet.